Yo, what's going on, guys? We're back with another recipe, with another saucy content, baby. In this video, I'm gonna be discussing and I'm gonna be talking about the ICT market structure. All right. So I'm gonna talk about where how ICT reads price and how he uses market structure. Um, you can watch this video and later on you can watch the 2022, I think it's episode 12 or 13 in the 2022 model playlist, where he talks about this topic right here but not in such detail. So I really suggest you to either look at this video first and then go back and take a look at his executions and his video on the episode 12 or 13. I'm not very sure. All right. I've been watching that specific video more than 20 times. And I'm not gonna lie, all credits to Zeusy, Zeusy MMXM on YouTube, where he opened my eyes to understand the lecture more clearly, and Larry Williams, where he is the actual founder of this type of market structure, where ICT got his idea from him and then he basically just tuned it, right? So this is when you see ICT place, this is where you see ICT place his stop losses, and this is when you get these entries with them tight stop losses. So this is because of not 100% relying on this market structure concept, but this is a part of it, and this can help you with bias, better entries, better stop loss placement, and patience. So taking a look at the intermediate term high first, all right? So as I've written down here, like a note, an intermediate term high is when price has a short-term high to the left and a short-term high to the right. Just like this, I've put a circle to the different type of highs. So this right here should be red, just like that. Um, an intermediate term high is formed when price rebalances an imbalance and forms a new low with displacement. So right here, and I've also written EVG. So this could be an EVG right here, right? So whenever you're trading ICT, whenever it is, you always wait for a liquidity sweep. So let's say right here, what you're going to wait for is the short-term high is always the engineered liquidity. It's going to be the low resistance, the equalizing lows, the trend lines, the low volume highs and lows. This is where the short-term highs and lows are going to be. The intermediate term high basically is a high that runs liquidity, all right? So this also can be stated as a short-term, long-term high, if it makes sense. All right, so we have a high, a short. So basically this looks like a head and shoulders, but it's not. All right, so the formation is like this. It's a very strong formation. If you get this with displacement, it's very nice. All right, so this is when price runs into liquidity, forming a high before the major liquidity, which could be an equal high or low resistance or whatever you want to call it. Then we go up, take out the liquidity, and then displacement down. And then we retrace back into a fair value gap or an imbalance. Right here, when you see green candles going up into here and then form a swing high in here, all right, in the FVG, this is going to be your intermediate term high, all right? So how you can find the high probability market structure shifts and breaks is by the help of this type of market structure that ICT uses, all right? So let's say we had an intermediate term low right here. So we said an intermediate term high or low is formed when price rebalances an imbalance and then forms a new low or high with displacement. So of course we're going to see displacement up here because it's going to be a liquidity sweep. That's gonna be a manipulation move, which is going to be fast. So it's going to be with displacement or with energy, with power, right? So since this low formed a new high, since this low rebalanced in an imbalance right here, this is going to be an intermediate term low right here. So when this intermediate term low breaks with displacement, that's a shift in market structure, which I'm going to use orange for that. So as soon as we see that market structure shift, we see that low get violated with displacement, this automatically becomes our intermediate term high. So the algorithm does not need to trade higher than this level if we really are bearish. If really the market, the algorithm has changed from buy side delivery to sell side delivery. All right. I don't know if I'm explaining it well, but I'm trying my best. And as always, it's going to be a long video, so I want you to stay with me if you really want to learn this market structure type. All right, so the same as right here, this is for a bullish scenario. This was a bear scenario. Taking out liquidity, short-term low, which is going to be your session highs and lows, which is going to be your engineered liquidity, Asian low, whatever, all right? Taking out the short-term low, all right? Let's say we have this high being our intermediate term high, right? Intermediate term high, takes out liquidity, takes out the short-term low. Now what we have here is a formation like this. What you're going to wait for is this right here. So either you enter right here and then you can put your stop loss here, or you could enter here and put your stop loss here, right? So that's what it is for. So we take out liquidity. Intermediate term low forms when we take out this right here. We violate it and we close above it with displacement, CISD. All right, CISD. And then what we're going to have right here is a fair value gap. Since we're most likely going to have a fair value gap, that's what makes an intermediate term low high probable, and that's what makes an intermediate term low rebalancing and imbalance, which is a fair value gap. Right, so we're not going to have a fair value gap right here all the time, but most of the time we're going to have it. So as soon as we close above this high right here that formed the new low, that formed the liquidity, so that made price to take out the liquidity, as soon as we close above it, this now, since this was an intermediate term high, which its name is in itself intermediate, then if this intermediate term high gets violated, then the algorithm has shifted gears. All right, so we come down into the FVG, into the imbalance, into discount, whatever. We're not, as I said, we're not going to have a fair value gap right here always, but most likely we are going to have it. All right, so this is your 2022 model. If you're going to take this trade right here, and your stop is going to be right here. All right, so yeah, we talked about that one. Now let's move to the long-term highs and lows. So a long-term high is when price has two intermediate term highs to the left and to the right of it, just like this. we have a short-term high, and now we have a intermediate term high because we rebalanced an imbalance right here. All right, we have a short-term high to the right of it, so that what makes an intermediate term high. Two short-term highs to the left and the right. We could also have something like this. This is a short-term high to the left and an intermediate term high to the right, right? So this is when now we have the intermediate term high, and then we go up, right? Take out liquidity, and then we drop, close below, we go up, short-term high is formed, going lower, intermediate term high is formed when price got a short-term high to the left of it and a short-term high to the right of it, or intermediate term high. When does this become an intermediate term high? When we have an FVG right here, because price makes an intermediate term high when we rebalance an imbalance. So right here. So now this is going to be when this formation is formed right here. I do not expect price to come back all the way to take this out, all right? In specific times, it will when we are going to be against the bias or when the algorithm has shifted gears. Let's say how do I say this? Let me think. Okay, so the duration of this long-term high was to get price to this key level slash PD array, all right? PD array, higher time frame, of course. So that was the duration of this long-term high to take price to here. So now we can expect price to go higher. So this is when you have to align things with the higher time frame, bias and liquidity and time. So the same thing with long term. Wait, I messed up. I think, yeah, here. The same thing with the long term low is going to be, we are going to have a intermediate term low to the left and intermediate term low to the right of it. All right. So in order to that intermediate term low to be formed, we need to have a short-term low to the left of the intermediate term low and a short-term low to the right of the intermediate term low. And then go lower. And then this is not formed yet. This is an intermediate term low now. All right, so this is an intermediate term low now. But then when price prints and gives us this kinds of formation, another intermediate term low, which is a short-term low to the left of it and a short-term low to the right of it. And that becomes an intermediate term low right here, and that's when our long-term low is formed. So we do not expect price to come down here after we go up. All right, so now we just follow the bullish order flow, and we just are going to be sync in with the buy program until we shift gears. As I said, as I stated earlier, is this long-term low is going to hold until the duration of this price movement is done. Let's say we have a weekly objective, a monthly objective, a 4-hour objective. Price is fractal, by the way, so this you can apply this to every time frame. So let's say if you're on the 1 minute, let's say this is your 1 minute long-term low. This is going to be your 15-minute PD array, all right, slash 1 hour PD array maybe. I would like to use the 15 to 30-minute PD array right here. So the duration of this long-term low, in order for it to hold, the duration for it to hold is going to be this much, just to get price to its goal, to its objective, which is right here. All right, so I'm going to try to find some example in the charts. I have one right here. Just let me clear everything real quick. All right, so this is a beautiful example right here. So what do we have right here is a look, this is very beautiful. Why? This is this is this is what? So we took out liquidity, right? But for me, this right here, this is against the trend. So this is an engineered liquidity, or just basically just internal external on the higher time frame right here. So just tapping into the order block, bullish CISD order block, retracement lower to go higher. So this right here is a short-term high, and this right here, now this doesn't become my intermediate term high yet. Well, for me it is. I'm sorry, it is an intermediate term high. Why? Because we closed below right here. What did this low do to price? It made price to go higher. Take out these minor medium liquidity right here. 1, 2, 3, 3 drives on the lower time frame. 1, 2, 3, and 4, right? So this made a new high. This is what? This low is an intermediate term low. Why? Because price made higher high and it came off of a fair value gap, an imbalance, took out liquidity, short-term low, intermediate term low, intermediate term low on the lower time frame. So now when this breaks with displacement, now this high, since we have a shift in market structure, this now becomes a intermediate term high automatically for me. And we are going to be targeting lower right here, these sell sites right here. So right here, this is going to be my intermediate term high. So right here, what we can do, let's say this is the lower time frame. This is the daily, but what this is a order block. This is an order block right here. And these two green candles right here, this is your CISD, right? So the first the first order block after the CISD is an order block. It's not a CISD. So we do not have two CISDs here, because CISD stands for a change in state of delivery, and delivery has already changed its state right here, right here. So tapping back, going back into premium, into PD arrays, and going back to fill the imbalance right here, this is when my intermediate term high forms, and this is when I do not expect price to go higher than this if we really are bearish. All right, so this is when you accept losses. This is when you filter out revenge trading and a lot of losing trades. This is when you know that you were wrong. This is when you know that you're not the problem, the market is just against your bias. So this is like these small changes that just change the whole game and how you play the game as a player, right? These are the tools. Um, so let's say you short on the order block, and you can easily put your stop just right here. Why? Because this is now your intermediate term high right here. We do not expect price to go lower than that. You see beautifully algorithmic price delivery right here, beautifully taps into the order block, and then going lower takes out liquidity right here. Now this is my intermediate term high. When price, now we took, what did we take out here? We did two things right here, right? What we did was we took out liquidity. But for me, okay, so I want you to be very careful right here on what I'm about to say right here, right? This right here is not a liquidity sweep. For me, I'm talking about my own experience and my own perspective right here. In order for me to have a clean and a valid liquidity sweep, for me, that is at least this much of a heat, this much of a wick. All right, I want deep. this right here is two things. All right, this is how I see it based on my experience. This is how I understand ICT. This is a very short-term liquidity sweep. Okay, so in order to go higher, we need to take out liquidity. But taking out this liquidity by this small tick is just for price to engineer liquidity to go lower even more. But first, we need to go up. So in order to engineer liquidity, we need to take a small portion of the liquidity, engineer liquidity at the same time. For me, this is very relative equal lows. I know we swept it. Okay, this for me is a short-term sweep. All right. So now since this is the daily time frame, we need retail to engage the market right here. We need support and resistance traders to engage the market right here. As you can see, 1, 2, and then 3. So in order for me to see a reversal from here, is at least come down here. All right? At least a couple of 100 points, 150, 200, I don't know. I can't count points for some reasons, but I just do it with the box. So in order for a valid liquidity sweep to happen to me, or for me, is I want to see a deep manipulation. This small touch right here is taking a small portion of the liquidity and engineering liquidity at the same time. So we can get retail, because in order for, this is where smart money pairs their orders. This is when this is when retail sells the sell limit orders, right? So this is when smart money sells from here, they buy back from here, goes up into premium, all right? This is where smart money resells, all right? So this right here is where smart money resells. Smart money did two things right here. They engineered liquidity, took out liquidity at the same time, but a small portion of it. They sold out their positions, engineered liquidity to layer more money right here, to layer more liquidity right here. All right? So we have tons of buyers right here. Smart money sold their sell positions right here and bought right here and engineered at the same time right here. Price goes up into premium. All right? Now this becomes my new intermediate term high. And this, I can now anticipate a power of 3 candle, and then just going lower, boom. Now this is a beautiful, beautiful, beautiful liquidity sweep right here. This is now where I anticipate a reversal with this kind of sweep right here. All right. So this is what I consider a reversal right here. Very beautiful. And then, boom. Now what we have right here is okay, so we had this candle, this candle, this candle being responsible to take out liquidity. What I really wanted to see right here is if we closed above right here, this, you can say this is a CISD, because since these 1, 2, 3, 4, these 4 or 5 consecutive candles got violated by one single candle right here. So this right here, this is when I'm shifting gears. All right, we targets met. Now our intermediate term highs are now going to be targets. So this now becomes a intermediate term low for me, since we have a short term low to the left. And now this becomes an intermediate term low for me. So now I can participate just right here. Order block, and my stop can be where? My stop can be below the intermediate term low. If you look at my first video, I talk about this breakaway gap right here. why this is a breakaway gap. You can put your stop here or just at the high of this fair value gap right here. Why? Because if you look at if you look back right here, this is a classic power of three, classic day candle right here. This is a dealing range on the lower time frame. So this is the daily time frame. You see this beautiful bullish high volume with displacement candle. When we go back, when we price comes back down here and fails to close below the 50%, this is now a fair value gap on the lower time frame. You see that? This is the dealing range. This is real dealing range. So now when I see this, this will act as a breakaway gap for me because we retraced back into the range. We do not need more retracements, right? So now let's say for instance I entered here. My stop does not need to be right here. All right, this is very like price does not need to come back down here or here or here or here. So the most logical stop loss placement for me is this right here, intermediate term low. Why? Because rebalanced and imbalanced on the lower time frame, and this inversion right here. So we rebalanced and imbalanced, which is this inversion for value gap right here. So for me, the candle slow that rebalanced the imbalance, which is the IFVG, is now an intermediate term low. So I can easily put my stop there. Now targeting what? Buy side liquidity, swing highs, resting. Liquidity resting here. Sorry about that. Why? Because now price has shifted gears from being bearish to bullish. Target one met. All right. Now this, okay, you see, since this was a engineered liquidity right here, what price did manipulate to the downside very quickly. You can see this still being respected. This never got taken out because this doesn't need to be taken out if we are bullish. All right. So now what I'm waiting for, and we just get it back into this chop, 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 chop right here. So now this becomes my long-term low. Why? Short-term low, short-term low, intermediate term low, intermediate term low, intermediate term low. I hope you can see that. So it's a little bit very messy here, but I want you to see it, I hope, since I cleared my annotations. But short-term low, intermediate term low, intermediate term low, intermediate term low, short-term low, intermediate term low, short-term low, intermediate term low, long-term low. So now this for me is a long-term low. All right, everybody? So what I can anticipate now is, so price has been very tricky to me. I'm not going to lie. Right here, I ended up in this chop right here, and I'm not gonna lie, I blew a account right here, a funded account, but I'm okay with it. Like I really don't care because I really did my best, and I had my best performance being done in this chop of the my whole trading career right here. I traded since here, so I traded very well until we got into the chop, but we're all good. I mean, that was expected, and we just move on. Um, it's not shame to blow accounts. What really is shame is blowing accounts and not learning from your mistakes, because you can blow an account and you can learn from your mistakes. That's a winner. That's where you really win. All right, that's where you actually win. A winning trade is not a winner. A winner is when you lose and you learn from it. That's not a losing trade. That's not a account being blown. That's a real lesson. But the real loss, the real loser is when you blow an account, when you take a losing trade, when you revenge trade, and you keep on making the same mistakes again and again and again when you know your mistake and when you know you should not be doing that mistake again. But you still do it because you just do it. So that's the real loss right there, right? But blowing an account or a losing trade where you learn a new thing, that's a real winner. So I hope I really taught something new, opened some eyes, because this really was a game changer for me. As always, I can sit down here and talk about this all day. Like, I've just shown small and short examples. There's tons of examples, but I want you to study, go back to the 2022 episode 12 or 13, I'm not very sure. Go back to that lecture, study that, come back to my video, study both, take notes, go watch the Zeusis video. I'm not sure which video it is, but maybe just ICT Advanced Market Structure. If you search for that, it might pop up. And backtest on the charts. And also Larry Williams, he got a full course which you can get access to somewhere, which he talks about this. This is where you need to do the research. I gave you a small portion, and like, it's your own responsibility to do the research on your own, to do the back testing on your own. It's not easy, and that's the journey. Like, that's what it makes trading fun. The journey is the best thing. Like, the best stories comes after the worst times. Like, you have to suffer, you have to experience a lot. Like, if you look at it like a sport, I think with a clear mind, with a a good mentality, with a good mindset, I think it's fun. Trading is like a sport, and that's how you should treat it. You should be sporty. You should have the like, you should respect the rules of trading. Like, it's like soccer. I mean, just because a player fouls you doesn't mean you should go and fucking kill the player, or fucking go punch the player, or kick his ass. So when the market, like, gives you a foul, when the market um gives you a losing trade, don't try to revenge it. If I would give a gender to the market, I would say female. You should be like, you're not hitting a woman. Whatever she does to you, you're not hitting back. Let's say she hits you. You're not hitting back. You can't, because she's a woman. The market's the same shit. You can't hit the market back. You should treat it very nice. Like, whenever you have a losing trade and you understand this market structure right here, when you know when you have a losing trade, you don't have a losing trade. You're just wrong on the bias, on the direction. That's when the market tells you you're wrong. Either you flip, you reverse your position, or you're just done for the day. And you take one or two trades. This really helped me with taking less trades. My main problem in trading was over trading, revenge trading. Which helped me was the shift in the perspective of the way of my losing trades. So when I have an intermediate term high and low, when where I have my stop below or above, when that hits, um, then I either shift gears, I either reverse my position, or I'm just done for the day, because based on my data, I'm right most of the time. But what makes me not being right sometimes is just reading price wrong, or bad preparation, or bad day, or these small stuff in your daily routine, these small little changes that you don't notice, um, this is what causes the losing trades. And if you're smart enough to take these as a signal and not something bad, start taking like the revenge trading nerve as a signal. Just take it. Oh, I want to revenge trade. Let's just stop, and I'm just waiting for the other day. Oh god damn it, I talk a lot. So okay, so just let me end the video right here. I hope I gave out some new recipes, some good saucy content. So don't forget to subscribe if you really enjoyed the video. Follow me on X, Twitter, join my Telegram group. Everything is in the link in the description. Leave a comment on whatever you suggest on what the next video should be about. And until next time, be safe. Peace.